At this week's FT Banking Summit in London, I caught up with Bob Diamond, the former Barclays chief executive, who's now focused on investing in African banking through his new Atlas Mara venture. I asked him why he thought African banks represented the best opportunity in global financial services today.
Martin, it's a number of dimensions. I think Africa itself is exciting. It's the demographics, the 18-year average age, more babies born each year in Nigeria than there are in Western Europe. It's the growing urbanization and middle class, 52 cities with 1 million people. Within 20 years, half the population of sub-Saharan Africa will be in the cities. Technology leapfrogging the legacy technology. The sheer scale, if you think about 170 million people in Nigeria, within 5 to 10 years, it's going to pass Brazil as the 5th most populous country in the world. But it's also financial services. If we're right on the growth prospects for Africa, then financial services is going to lead them. But in sub-Saharan Africa, the business models are terribly simple. It's taking deposits and buying T-bills. T-bills, mind you, that yield 11, 12, 13, 14%. So it's economically the right thing to do. But the heads of state, the finance ministers, the central bank governors are encouraging lending to consumers and lending to small businesses. And that's how we want to be disruptive. We want to put real equity. We want to have majority positions so we have management control. We then want to integrate the banks that we acquire, banks in the SADC region, banks in the East African community, and banks in the ECOWAS region, particularly from Nigeria and Ghana. And we want to be a positively disruptive force, forcing lending in an environment where due to Basel III, a lot of the European lending and the US lending is pulling out and going back to the home market.
Mr. Diamond told me that he plans to build the biggest sub-Saharan African lender by patching together various acquisitions of local banks in Africa. That involves building an entirely new IT system from scratch, a huge investment.
Yeah, and I think that's why we raised equity, not a private equity fund, because we wanted permanent equity. And that's why we have a full management team, and I'm already gushing. But John Vitalo as CEO, Arena McDonald from Standard Bank as CFO, Brad Gibbs driving our strategy, Jyrki Koskello from the World Bank doing all of our acquisitions, Richard Mueller just joined as head of integration. We have a team second to none and really up for this challenge. And there is an investment, but we're able to acquire at very reasonable valuations, at book value, sometimes slightly below, with banks that have double-digit earnings. And these double-digit earnings are coming without a particularly large product set. We're going to develop, specialized lending units, capital markets platforms. We're going to implement technology that will give us better information on credit risk, on currency risk, on both for our customers and for our bank. So it is a serious investment. It's a 5 to 7 year project's the wrong word. It's a 5 to 7 years before we're going to really see the conclusion of what we're doing. It's not a passive investment. It's a very, very active investment.
Mr. Diamond says he sees a once-in-a-lifetime opportunity to buy some of the many assets that are being sold by global banks that have gone into retreat under pressure from regulators. I asked him whether the era of universal banks like Barclays, which he used to run, was now over.
Well, Martin, I think it's exactly the right question. And in Atlas Merchant Capital, Africa is a tremendous proof of concept of what we mean by merchant banking. It means financials have a tremendous opportunity. So financial valuations in the equity markets are down 35 to 40% since the crisis. And yet the equity markets without financials are up 35 to 40%. So you have a 70 to 80% valuation difference on 22% of the developed market economy, the financials. The buyers of financial businesses for the last 20 or 30 years have been the big banks. And because of Basel III, because of too big to fail, they can no longer buy. In fact, they're sellers. And there is more supply coming out of the market. As you said, there's 1.4 trillion euros of non-core businesses. These aren't mortgage securities, these are businesses that are going to be sold just from Eurozone banks over the next couple of years. As a proof of concept, in Atlas Mara in Africa, we've acquired 3 banks, and in not one of those situations has there been another bank bidding against us.
Rival bankers are somewhat bemused by Mr. Diamond's comments at this week's FT Banking Summit, and they say there's a deep irony in the fact that a man who until a couple of years ago was running one of these big global banks in the form of Barclays is now operating a venture that's looking to profit from buying some of the assets those global banks are forced to sell. However, Mr. Diamond seems determinedly optimistic about his new venture and is pushing on regardless. Martin Arnold, Financial Times, London.